Every single trading day, over $130 billion changes hands in the global gold market. It's just, it's a massive, relentless ocean of capital.
Yeah, it really is.
But there's this reality that might make you entirely rethink how you look at a chart. What if I told you that the exact moment an xauusd chart looks the absolute safest to buy is the precise second that institutional algorithms have been mathematically programmed to trap you?
Oh, that's the absolute truth. And you know exactly what we're talking about here.
Right. You've done the analysis, you've marked your levels, your overall bias is completely correct. I mean, the market is fundamentally bullish, but you hesitate.
You sit there and watch it.
Exactly, you watch. And then the moment you finally surrender to the momentum and click buy, the market instantly reverses. It just aggressively spikes down, hits your stop loss, takes you out, and then almost like it's mocking you, it immediately continues exactly in the direction you originally predicted.
It's the absolute definition of the entry paradox. And honestly, it is the most frustrating, psychologically draining experience you can face as a trader. It feels personal.
It really does.
It feels like the market is looking directly at your broker account.
Yeah.
But understanding why this happens is the great separator in this industry. Retail traders don't generally fail because they lack technical knowledge or, because they can't read a higher time frame trend.
Right.
They fail because of a profound inability to synchronize their emotional state with mechanical execution. They are trading their feelings while the institutions are trading the liquidity.
Yeah, and if you are a beginner trading gold right now, this is likely your daily reality. You're just trapped in this exhausting cycle of hesitation followed by impulsive action. You predict the move, but you hesitate to enter because you're paralyzed by the fear of losing. And then when the move is already happening, when it's dominating the screen and looks undeniably safe, you enter. And that is exactly when the trap snaps shut.
Let's really paint this picture because every listener who trades gold knows this feeling in their bones. Picture yourself staring at the xauusd chart right now. You're watching a 15-minute time frame.
Okay, I'm picturing it.
The market has been consolidating for hours, just moving sideways in a tight, choppy, agonizingly slow range. You're waiting. Suddenly, volume finally enters the market. You see a massive, fast-moving, bullish green candle breaking powerfully past a resistance level you marked during your morning prep.
The price is surging.
Exactly. You can physically feel your heart rate elevate. The fear of missing out, FOMO, completely takes over your executive function.
You just feel this absolute terror that the market is going to leave you behind because you know gold, right? You know it can move $20 in a heartbeat.
Oh, easily.
You see this massive daily range unfolding in real time. So acting purely on that intoxicating rush of adrenaline, you click buy right at the absolute top of that massive green candle. And for maybe 3 seconds, you feel a momentary sense of relief because you're finally in the trade.
But then, the mechanics of the market actually engage. Suddenly, the momentum just dies. It hits an invisible wall.
Yep.
The bid-ask spread widens slightly, and the candle begins to pull back. Within seconds, that massive, solid green body that looked so incredibly convincing starts to evaporate. It turns into a long, thin wick.
That's brutal.
The price collapses aggressively back into the consolidation range. Your stop loss is triggered. You're out of the trade with a painful loss. And then comes the ultimate psychological torture, right? 15 minutes later, the market slowly, methodically continues its upward trajectory without you.
The psychological pain of that exact moment is just crushing. It leaves you with confusion, intense hesitation for whatever trade you try to take next, and the terrifying realization that you didn't enter based on your mechanical system. You entered purely on emotion.
You just reacted to flashing lights on a screen.
Yeah.
And we have to be brutally honest here. That emotional reaction is exactly what institutional algorithms are engineered to provoke.
Right, they don't move price randomly.
No, they engineer that massive green candle specifically to trigger your physiological response, force you to enter at the most disadvantageous price possible, and use your desperate buy order as the necessary liquidity to fill their massive sell orders. They weaponize your own psychology against you.
Which brings us to the core mission of today's deep dive. We are going completely under the hood of xauusd candlestick entry points. We're going to strip away the emotion, the hype, and the flashing lights, and we're going to look at real institutional price action, liquidity dynamics, and market structure.
It's so necessary.
We're drawing from a comprehensive stack of professional Forex trading sources, order flow mechanics, and institutional models to fundamentally rewrite how you interact with the chart. The goal here is a complete transformation. We want to take you from being an emotional, reactive trader who chases moving candles and turn you into a calm, patient, almost robotic executor of a mechanical system.
That's the only way to survive.
So, think about your last 10 trades. How many of them were entered simply because a candle was moving fast and you couldn't bear to miss out? If you've ever entered a trade emotionally after seeing a strong candle, comment why, so I know I'm speaking to the right people.
If the answer is more than 0, then the very first thing we must do is fundamentally redefine what a candlestick actually is.
Let's do it.
Because the absolute greatest misunderstanding among beginners, the original sin of retail trading, really is the belief that a single fast-moving candle is a command to enter the market. It is not a signal.
Wait, it's not.
No, a candlestick in isolation is never an entry signal. It's merely a historical snapshot of a negotiation between buyers and sellers over a highly specific arbitrary time frame.
Let's break that down, because I think people look at candles as these, living, breathing entities, but really, we need to look at a candlestick like a battlefield report.
That's a great way to think of it.
Think of it structurally. The body of the candlestick represents the territory that was captured and successfully held by the end of the session. It shows true conviction and market acceptance of that specific price level. The wicks, however, represent the battleground that was intensely fought over, heavily scouted, but ultimately lost.
Exactly. The wicks show rejection. That is a highly accurate way to visualize it. And because beginners focus almost entirely on the intra-candle movement, the rapid flashing of green and red while the candle's still open and forming, they completely miss the final outcome of that negotiation.
They're watching the fight instead of looking at who actually won the territory.
Precisely. Professional traders, institutional algorithms, they focus almost exclusively on the closing price. The close is the final consensus of value. Until that candle physically closes and prints on the chart, any aggressive movement you see is highly likely to be manipulation designed to test liquidity pools and trick your emotions.
Wait, hold on. If I see a massive green candle breaking resistance, my brain is screaming that the buyers have won. It's undeniable momentum. Why on earth would I look at that and think, this might be a trap? Shouldn't I just jump in to catch the rest of the wave?
That instinct right there is the retail mindset. And it is the exact mechanism that gets you trapped. For a professional, a momentum candle, what we technically call displacement in the market, is actually a signal to wait, not a signal to execute.
Explain the mechanics of that. Why wait when the market is clearly moving?
Because of how order flow works. When institutions inject massive volume to displace price, meaning they buy so aggressively that the price rockets upward, they create severe inefficiencies in the market.
Inefficiencies, right.
The price moves so quickly that it literally skips over price levels. It leaves behind pockets of unfilled orders, which professional traders refer to as fair value gaps. If you enter on that massive momentum candle, you are chasing price.
You're jumping in too late.
Yes. You are buying at a premium after the move has already occurred. You are mathematically destroying your risk-to-reward ratio. For professionals, that massive momentum candle simply confirms that the trend is real, but it also dictates that they must now patiently wait for the market to retrace back down to fair value to fill those gaps before they can enter safely.
So it's almost like an elevator skipping floors. The momentum is the elevator shooting up from floor 1 to floor 10 so fast that it doesn't stop to pick anyone up at floors 2 through 9. But the market, like a vacuum, hates empty space.
It absolutely does.
It has to come back down to those stepped floors to balance the books before it can keep going up to floor 20.
Precisely. The market is an engine of efficiency, and a momentum candle is inherently inefficient. It requires a correction. So you buy at floor 10, you're going to suffer the entire drawdown as the elevator goes back to floor 5 to pick up the institutional orders.
Which leads us to the second state of market behavior, right? Exhaustion candles.
Yes. So if a momentum candle is the institution stepping heavily on the gas, exhaustion is what it looks like when they take their foot off.
Is that where we see the body shrinking and the wicks getting longer?
Exactly. Exhaustion candles are a critical footprint, particularly in the gold market, because of its high daily volatility. They frequently occur when price approaches a major psychological level. Gold traders are heavily influenced by round numbers, $2,000 an ounce, $2,050. When price reaches these levels, the dominant force in the market begins to lose control.
How does that actually look on the tape, though? What is mechanically happening to create that long wick?
Mechanically, buyers are still trying to push the price up, hitting the ask. But at that psychological level, massive institutional sell limit orders are sitting on the books. Every time the retail buyers push the price up a few cents, they hit a wall of institutional supply.
So the big players are just absorbing all that buying.
Yes. The sellers are aggressively stepping in, absorbing all that buying pressure and forcing the price back down before the 15-minute or 1-hour time frame expires. The candle closes, leaving a long upper wick. It physically illustrates that the momentum is dying, the prevailing trend has run out of fuel, and the buyers have been rejected at that price point.
Okay, so we have momentum, which creates gaps, and exhaustion, which shows rejection. Then we have the third state, compression candles. This is when the market just goes dead quiet. The ranges tighten up, the candlestick bodies are tiny, and the wicks are just overlapping each other back and forth.
Right.
To a beginner, it looks like a period of complete indecision. It looks boring.
It looks boring to the amateur, but to the professional order flow trader, it looks like a coiled spring. Compression is not indecision, it is a state of intense energy storage. In the background, the market is aggressively building up orders on both sides of a very tight, defined range.
Building up liquidity.
Yes. Buyers are putting their stop losses just below the range, and sellers are putting their stop losses just above the range. Compression mathematically guarantees a massive expansion is coming. But here's the fatal trap. The initial breakout from a state of compression is almost always engineered to be fake.
Let's pause there, because this is where xauusd has a very specific, almost notorious personality trait. The gold market is famous for something called the Judas swing.
Yes, the Judas swing is arguably the ultimate institutional deception, and gold algorithms utilize it relentlessly. The Judas swing is a fake expansion candle, a massive, visually convincing breakout that usually happens right around the opening bell of a major trading session, like the London Open or the New York Open.
So paint the picture. What is the sequence of a Judas swing?
Imagine the market has been in that boring compression state all through the Asian trading session. The range is tight, then the London session opens. Suddenly, the price violently breaks out of the top of that compression zone. It creates a massive, solid green candle.
And people just lose their minds.
Exactly. Retail traders, who have been bored for hours, see this momentum. They experience an immediate surge of dopamine and FOMO, and they aggressively pile into breakout long trades.
They see the flashing green, they assume the coiled spring has finally released its energy upward, and they buy.
And that is exactly what the institutions need them to do. The moment sufficient retail money has entered the market, buying at the absolute highest premium price, the institutions execute their real strategy. They reverse the price aggressively. They sell heavily into all that retail buying pressure.
Wow.
Before the 15-minute candle can even close, the price is driven completely back inside the compression range. That massive green body turns into a giant wick. The true directional move begins in the exact opposite direction. The retail breakout traders are instantly stopped out, and their losses, their sell orders, when their stops are hit, literally provide the fuel for the institutional move downward.
It's like a financial Venus flytrap. They secrete the sweet nectar, the flashing green momentum candle to lure you in, and the second you land, it's snatched shut.
That's a perfect analogy.
And this emphasizes the absolute non-negotiable core lesson of reading price action. You must wait for the candle to close. The closing price is the only verifiable truth on the chart. All intra-candle movement is an illusion, an advertisement designed to manipulate your emotions and trick you into providing liquidity.
Right. Intra-candle movement is an advertisement.
If you want me to break down candle behavior step by step, comment candle. Because this really forces us to move from the mechanics of the chart to the mechanics of the human mind. We have to delve deeply into entry timing psychology.
This is so important.
Why do intelligent, rational people consistently chase these moving candles even when they know they shouldn't?
It comes down to a profound psychological hijack. When gold spikes, when you see that violent vertical upward movement, your brain literally releases dopamine. It's the exact same chemical reaction as pulling the lever on a slot machine and watching the wheels spin.
You're reacting to the intoxicating high of a potential winning feeling.
Yes. In that moment, You are no longer performing logical structural analysis. You are acting out of an intense primal fear of missing a financial opportunity. And it triggers an overwhelming wave of confirmation bias.
How so?
When a beginner sees a large green candle surging upward, their brain instantly filters out all contradictory information. They ignore the surrounding market context completely. They don't see the major daily resistance level sitting just 10 pips away. They don't see that the higher time frame structural trend is aggressively bearish.
They only see what they want to see.
Exactly. They only see the green movement because that is the only thing that confirms their desperate emotional desire to enter the trade and make fast money.
Okay, but how do we cure this? How do we rewire that instinct? Because telling someone don't be emotional is like telling someone don't be hungry. It just doesn't work.
No, it doesn't. You cure it through mechanical understanding. You have to internalize the harsh zero-sum reality of institutional liquidity. The Forex market is not a magical money printer. It is an exchange mechanism. For a major financial institution to buy, say, $100 million worth of gold at a specific price, they must find someone or group of someones willing to sell them $100 million worth of gold at that exact same price.
Because if they just hit the buy button on their terminal for $100 million, there wouldn't be enough sell orders sitting there to fill it.
Exactly. If they execute a massive market order without sufficient resting liquidity, the price will skyrocket instantly due to lack of supply, and their order will be filled at progressively worse and worse prices. This is called slippage.
And they hate slippage.
Institutional algorithms are designed specifically to avoid it. Therefore, institutions absolutely need retail traders to enter at the wrong time. They mathematically require you to buy the absolute top so they have someone to sell to. They require you to panic, sell the absolute bottom so they have someone to buy from. Your emotional mistake is their entry model.
Let me ask a really fundamental question then. If I'm looking at a chart and the market is violently falling, massive red candles, total panic, why exactly do institutions look at that and decide to buy? And conversely, why do they sell when it looks like it is aggressively rising and perfectly safe?
Because they operate on a completely inverted timeline compared to retail traders. Retail traders enter after the expansion has already occurred. They wait until the candle is massive and green because their brain tells them it feels safe and confirmed. They're essentially chasing the shadow of the move.
Right.
Institutions, however, are the ones who initiate that expansion. And after they initiate it, they wait for the pullback. They enter their massive secondary positions during the retracement when the price falls back into those fair value gaps or order blocks we mentioned earlier. They're actively entering when the current short-term price action is moving against the primary trend, because that specific zone is where the financial risk is the absolute lowest and the potential reward is the highest.
This requires a really uncomfortable, profound, emotional realization for anyone listening. You have to look in the mirror, look at your trading journal, and accept this brutal fact. You have been entering too late.
Way too late.
By the time the candle looks massive, green, and completely safe to your emotional brain, the true profitable move is already over. The smart money that bought the bottom 20 minutes ago is already actively taking their profits. And how do they take long profits? By selling.
And who are they selling to?
You, the person buying the top of the green candle. You are literally mechanically providing the exit liquidity for the professionals.
It is a bitter pill to swallow, but understanding this completely shifts your entire trading paradigm. You stop looking for momentum to jump into, and you start looking for momentum to pull back from. You stop reacting, and you start anticipating. Which brings us directly to the mechanical candlestick entry models that professional order flow traders actually use to execute positions.
Right, we need to move from theory to practical application here.
Exactly. The first and arguably the most powerful model in the highly manipulative gold market is the rejection entry model.
Okay, let's break this down meticulously step by step. I want you to be able to visualize exactly what this looks like. The rejection entry model starts with price approaching a key structural level on the chart. Let's say a major daily support or resistance zone.
Correct. The context is everything. As price approaches this key established level, we are not just blindly setting limit orders, we are looking for a highly specific sequence of events. First, a candle must actively pierce that level. It must push completely through the support or resistance zone.
A fake out.
Yes. This is the liquidity sweep. It is a deliberate move designed to accomplish two things. Trigger the stop losses of traders who place their protection just behind the level, and simultaneously trick impatient breakout traders into entering the market in the wrong direction.
So to the untrained eye, the candle pierces the level, and it looks like a perfectly confirmed breakout. The breakout traders are piling in. But then what mechanically happens to create the rejection?
The trap is sprung. Before the time frame for that candle expires, massive opposing institutional volume enters the market. The breakout traders are suddenly overwhelmed by limit orders. The price is aggressively driven back in the opposite direction, and the candle ultimately closes back inside the original structural range.
Leaving that wick behind.
Visually, yes. This leaves a very long wick protruding entirely through the key level. This is what retail traders commonly call a pin bar or a hammer.
But here is the crucial missing piece. The rule that absolutely destroys beginners who read a basic candlestick book. You do not enter just because you see a long wick. Seeing a pin bar is not an immediate green light command to execute a trade.
Absolutely not. That is a fast track to blowing your account. A single rejection wick is only a hypothesis. It suggests that institutions have swept liquidity and are attempting to reverse the price, but it does not mathematically confirm it. You must demand proof. You must wait for the validation candle.
What does the validation candle look like?
The very next candle must move decisively in the opposite direction of the wick. If you have a long lower wick that just rejected a major support level, suggesting a bullish reversal, the very next candle must be a strong bullish candle that closes higher than its open. That second candle is your structural validation.
It proves they actually shifted gears.
Exactly. It proves the order flow is actually shifted. You execute your entry on the close of that validation candle, or perhaps on a slight micro retracement into its body, and you place your protective stop loss firmly behind the absolute extreme tip of the rejection wick.
That one rule alone, waiting for the validation candle, eliminates so many false signals and stop hunts. It forces patience. Now, the second model is the pullback entry model. This is for a different scenario, for when you actually have a real valid breakout, not a fake sweep.
Yes, the pullback entry model is how professionals trade momentum safely without chasing. It begins with true, undeniable displacement. You see a large, full-bodied candle break cleanly through a major structural level, and this is the key. It closes significantly beyond it.
So it's not just a wick this time.
No, this is a true break of structure. It visually demonstrates massive institutional commitment to the new price level.
But again, relying on our new rule, we do not chase that displacement candle. Even if it closes strong, we don't buy the close, we wait.
We wait for the retracement. The market breathes in, and the market breathes out. Price will almost inevitably pull back to test the structural level it just broke, or it will retrace to fill a fair value gap that was left behind by the sheer velocity of the displacement candle.
I always like to explain this using a physical analogy. It's exactly like checking if a frozen lake is safe to walk on in the winter. The initial breakout, that strong displacement candle, is someone boldly stepping out onto the ice. It looks solid, it looks brave, but you don't actually know if it can hold weight yet.
That's right.
The pullback, the retest, is them jumping up and down on the ice to see if it cracks under pressure. If the ice holds, if the broken resistance level now acts as a firm, undeniable support level, then, and only then, do you know it's safe to bring your capital onto the ice.
That is an exceptionally accurate analogy for price action. You are patiently waiting for the market to biologically prove that the old ceiling has genuinely transformed into a new floor. During that exact pullback phase, you are analyzing the microstructure.
Looking for validation again.
Exactly. You are looking for a rejection candle, perhaps a small pin bar, a doji, or an inside bar resting exactly on that freshly broken level. When you see that hesitation, that clear rejection of lower prices at the new support, followed immediately by a continuation candle in the direction of the original breakout, that is your high probability professional entry point.
It's methodical. It's almost boring, which is exactly how good trading should be. The third model is the breakout confirmation entry, which deals specifically with that compression phase, that coiled spring we talked about earlier.
Yes. In this scenario, you have successfully identified a tight compression box on your chart. Price has been moving sideways in a very narrow defined range for an extended period, building up massive dormant orders. But eventually, a strong volume candle bursts out of this box.
And as we discussed, this is the exact moment amateur breakout traders enter and get slaughtered by the Judas swing.
Because they assume the initial breakout is the final, definitive move. Professionals understand the deep statistical realities of xauusd. Entering immediately on a breakout candle from a compression zone in gold is statistically suicidal over a large sample size.
Gold is just too manipulative.
Gold is absolutely infamous for retracing deeply, sweeping the opposite side of the compression box before it initiates its real continuation. Therefore, when that initial breakout candle closes outside the box, the professional trader does absolutely nothing. They observe.
They wait for the retest.
They wait for the inevitable pullback to the very edge of the compression box. They meticulously verify that the edge of the box is now acting as solid support or resistance by looking for a rejection candle, and only upon that confirmation do they execute their entry.
If this part is changing how you see entries, comment 1, because there is a massive caveat we have to introduce here. A critical point to make is that none of these candlestick entry models mean absolutely anything in a vacuum. A rejection pin bar is completely, totally useless if it forms randomly in the middle of nowhere on a chart. Candlestick entries must, without exception, be combined with market structure.
Market structure is the absolute foundation. It provides the overarching framework of price correction. Without understanding structure, you are quite literally just trading random geometric shapes on a screen.
Right.
To understand structure, we need to clearly define two essential institutional concepts: break of structure, commonly abbreviated as BOS, and change of character, abbreviated as Xauusd.
Let's simplify these concepts so a complete beginner can visualize them instantly. A break of structure, or BOS, is simply trend continuation. It is the visual evidence of the market successfully climbing a set of stairs. In a healthy uptrend, price creates a high, pulls back to form a higher low, and then surges upward to decisively break the previous high.
And that exact moment it breaks the previous high is a BOS.
Exactly. It confirms the trend is mechanically healthy and that institutions are continuing to back the current upward direction with fresh capital.
Conversely, a change of character, or xauusd, is your very first profound warning sign of a potential macroeconomic trend reversal. Imagine that exact same stair-stepping uptrend. Price forms a higher high, but then, instead of pulling back and forming a higher low to continue the stairs, it suddenly collapses.
The stairs break.
Yes, it falls and breaks decisively below the previous higher low. The fundamental character of the market's order flow has shifted from bullish to bearish. The CACH is the initial structural failure of the trend to maintain its established geometry.
Okay, so a CACH is the alarm bell, and a BOS is the all-clear signal. So why do our specific candlestick entries absolutely require this structural context? Why does a pin bar fail?
Because entry models only have a high probability of success when they are perfectly aligned with the dominant underlying structural forces of the market. Let me give you a practical example. If you see a beautiful textbook, perfect bullish rejection pin bar, but it forms in the middle of a vicious, structurally confirmed bearish downtrend, far away from any historical support level, it is a low probability trap.
It's just a speed bump.
Exactly. It's just a minor speed bump for the sellers. The dominant order flow will crush it. However, if that exact same identical bullish pin bar forms precisely at a structural higher low within a confirmed stair-stepping uptrend, it suddenly becomes a massive high probability entry signal. Structure tells you exactly where on the map to look. The candlestick merely tells you when to pull the trigger.
This brings up the critical, everyday difference between real breakouts and fake breakouts, which we established are essentially institutional stop hunts. We talked about waiting for the close, but how do we visually, mechanically tell the difference on a chart when analyzing structure?
The entire distinction is based on the anatomy of the candle, close relative to the structural level. A real break of structure, a true institutional continuation of the trend, mandates that a strong candle body must close decisively outside and beyond the previous structural zone. It visually proves that buyers or sellers have committed real capital and accepted the new price level as fair value.
And a fake breakout. How does the stop hunt visually present itself?
A fake breakout fundamentally fails to close outside the structural zone. During the lifespan of the candle, it pushes aggressively past the structural level. It sweeps the resting liquidity, the stop losses, and breakout orders sitting there. But before the candle's time expires, the price is aggressively rejected back into the original underlying range.
So the body doesn't close outside.
Correct. When the candle finally closes, it leaves nothing behind but a long wick protruding past the structure. It is a failed attempt at displacement.
And regarding xauusd specifically, anyone who trades gold knows this. Gold almost universally performs a liquidity sweep, a fake breakout, before continuing its true intended trend. It is like it has to bend its knees before it jumps.
That's a great way to put it.
It sweeps the highs to trick retail buyers and grab sell stops, then it collapses. Or it sweeps the lows to trick retail sellers and grab buy stocks, then it rallies. It is a machine designed to inflict maximum psychological pain before moving.
Which is exactly why understanding the concept of liquidity is the true engine that drives the entire Forex market, and the gold market in particular. We've used the word a few times, but we need to define it mechanically.
Right.
Liquidity is simply the sheer concentration of pending orders waiting to be executed at specific price levels. The market is an algorithm that naturally, inevitably gravitates toward these massive pools of resting orders. Why? Because giant institutions require massive, deep liquidity to fill their multi-million-dollar positions without causing severe price slippage against themselves.
Let's break down exactly where this liquidity lives on the chart for an absolute beginner, because it's not hidden, it's actually glaringly obvious once you know what to look for. We have two main types: buy-side liquidity, or BSL, and sell-side liquidity, or SSL. Let's look at BSL first. Buy-side liquidity rests directly above previous swing highs on the chart.
And why is that?
Well, let's think about the mechanics. If you are a retail trader who just shorted the market, where does your textbook tell you to put your protective stop loss? You put it right above the previous swing high. And mechanically, what is a stop loss on a short position? It is a buy order to cover your position.
Yes.
Furthermore, retail breakout traders place their buy stop entry orders above those exact same swing highs, hoping to catch an upward surge. Therefore, sitting slightly above every single swing high on your chart is a massive concentrated pool of automated buy orders. That is buy-side liquidity.
And the exact inverse is true for sell-side liquidity. Sell-side liquidity rests directly below previous swing lows. Traders who are currently in long positions place their sell stop loss orders just beneath those lows. Breakout traders place their sell stop entry orders below those lows. So below every significant structural low is a massive, concentrated pool of automated sell orders.
This leads to what I think is the most uncomfortable, mind-bending truth in all of trading. Your carefully placed stop loss is an institution's ideal entry point. They do not view your stop loss as protection, they view it as fuel. They intentionally, algorithmically drive the price directly into your stop loss, specifically to absorb your order. Walk us through that mechanism. If an institution wants to buy gold, how do they use retail stop losses to do it?
It is a brilliant, ruthless mechanism.
Right.
Let's say an institution needs to accumulate a massive long position in gold. As we discussed, they need sellers. If they just buy at market, they get terrible prices.
Right.
So they look at the chart and identify a clear swing low where thousands of retail traders have placed their stop losses. The institution will actively spend capital to drive the price down, pushing it just below that swing low. Instantly, thousands of retail stop losses are triggered. Because those retail traders were long, their stop losses execute as market sell orders. A massive flood of selling pressure hits the market.
And the institutions are just waiting there.
The institution is waiting right there with limit buy orders. They absorb all that panic selling, accumulating their massive long position at an extreme discount. Once their order is completely filled, they stop suppressing the price, and they reverse the market aggressively upward. You get stopped out, they get their fill, and the market goes exactly where you originally thought it would.
This is what we call the institutional sequence, and recognizing it is mandatory for high probability gold trading. It is a predictable four-step cadence. Step 1, the liquidity sweep. Price pierces a key higher low to trigger the stops and grab the liquidity.
Step 2, the rejection wick. Because the institution is stepping in to absorb those orders, the price is aggressively forced back into the range, leaving a long tail or pin bar.
Step 3, the market structure shift. This is the confirmation. Price violently reverses and breaks the internal structure, creating a CHEH in the opposite direction, proving the institution has taken control.
And finally, step 4, the entry on the retest. The market pulls back to mitigate an order block or fill a fair value gap created during that aggressive shift, offering the patient professional a low-risk, high-reward entry.
And this highlights the most catastrophic beginner mistake: entering the market before this entire four-step liquidity sweep sequence completes. If you look at a major support level and you enter early simply because you think it looks strong and it should hold, you are making yourself the liquidity. You are the one being swept. You are the fuel.
You must cultivate the profound patience to wait for the trap to be sprung on the impatient traders, wait for the smart money to explicitly show their hand via a structural shift, and only then do you enter safely on the subsequent retest.
If you want me to explain liquidity manipulation on gold step by step, comment XAU. Now that we deeply understand the mechanics of price, structure, and liquidity, we have to talk about filtering the noise. Because the reality is, if you stare at a 15-minute chart all day, you're going to see 100 wicks. You are going to see engulfing candles constantly. It's a chaotic environment.
It absolutely is.
How do we determine which specific setups out of the dozens that form every week actually deserve our hard-earned capital? We must define incredibly strict, high-probability entry conditions.
Exactly. Not every pin bar is a valid trade. Not every break of structure is worth your money. A true high-probability condition demands deep confluence. It requires multiple structural and order flow factors to align perfectly. First and foremost, the setup must happen at a strong, undeniable, higher time frame structural level. We are talking about major daily or 4-hour support, resistance, or institutional order blocks. If it forms in no man's land, you ignore it entirely.
What is the second factor of confluence?
Second, there must be a clear, visually obvious liquidity sweep of a recent, significant swing high or low. The market must have definitively taken out retail stops. If there is no sweep, there's no institutional fuel for the move. Third, that sweep must be immediately followed by strong, undeniable displacement.
Right, a big move away.
We need to see a large body momentum candle aggressively moving away from the sweep zone, signaling true institutional intent and creating that critical market structure shift.
And the fourth factor?
Fourth, there must be a clear, pristine pullback into a valid fair value gap or the exact structural level that was broken. We never chase the displacement. And finally, the fifth and perhaps most important filter. The entire micro setup must align with the higher time frame macro trend. If the daily chart is massively structurally bullish, we are exclusively looking for liquidity sweeps of swing lows to enter long positions. We absolutely do not trade against the macro trend just because we see a temporary bearish pin bar.
Let's flip that around. What are the specific weak conditions that a trader must absolutely avoid no matter how tempting the candlestick looks?
You must ruthlessly avoid choppy, tight ranges, particularly during low volume periods like the Asian session. When the market is simply drifting sideways, printing small bodies and overlapping wicks, there is zero institutional intent present. It is just algorithmic noise. You avoid low volume environments where price is drifting aimlessly without displacing.
What about random wicks?
You absolutely categorically ignore random rejection candles that form floating in the dead center of a range, entirely disconnected from any major structural level. Trading in the middle of range is gambling, plain and simple.
Which brings us to a massively underappreciated filter for xauusd specifically, session timing. Time of day is arguably just as critical a filter for high probability as price structure.
It is vital. Professional gold traders strictly isolate the exact times of day they are willing to even look at a chart to execute trades. For xauusd, the absolute highest probability setups consistently occur during the overlap of the London and New York sessions.
Why that specific window?
This is roughly a 3 to 4 hour window where the highest volume of global institutional capital is simultaneously flowing through the Forex market. If you get a textbook liquidity sweep and a beautiful break and retest setup during this specific high volume window, there is a massive amount of institutional money actively driving the market. This ensures that the price actually has the logistical fuel to reach your profit targets.
And outside those hours?
Outside of these specific hours, the probability of fakeouts, failed breakouts, and endless frustrating consolidation increases exponentially.
This deep dive has really been a complete ground-up deconstruction of how to properly engage with the gold market. We have journeyed from that initial agonizing emotional frustration of the entry paradox, staring at the screen, clicking buy out of pure FOMO, and watching the market instantly reverse to destroy your account to a place of profound mechanical structural realization. The goal is that you, the listener, have arrived at a single, powerful, unshakable conclusion. I need to stop reacting emotionally to flashing colors. I need to stop chasing fast-moving candles.
That specific realization is the absolute genesis of a professional trading mindset. You must forcefully transition your identity from being a reactive, emotional participant who is constantly victimized by institutional algorithms to becoming a cold, patient executor of a highly mechanical system.
It's a complete paradigm shift.
It really is. You have to understand that missing a trade because a setup did not meet your exact, predefined, rigorous criteria is not a failure. It is the epitome of flawless risk management. You do not control the market's daily volatility. You do not control its direction or its sudden violent expansions. The only things you have absolute control over in this business are your precise entries, your overall risk exposure, and your infinite patience.
If you want a complete xauusd entry system using candlestick behavior, comment entry. I want you to really process everything we've unpacked today. Think about your chart. Think about the liquidity sitting above those highs and below those lows. Think about the elevator skipping floors.
And as we wrap this up, I want to leave you with one final, perhaps slightly provocative concept to deeply consider. It is something that fundamentally shifts how you view your daily role as a trader.
What's that?
Consider the very real possibility that, over the course of a trading month, the absolute most profitable action you can take on most days is to do absolutely nothing. Think about how the simple, disciplined act of sitting on your hands and forcefully waiting for a single 15-minute candle to fully, physically close could completely rewrite your trading history, from a cycle of consistent losses to a curve of steady profitability. Real, sustainable edge in the Forex market is not found in magically predicting the next massive green candle. It is found entirely in the quiet, unglamorous discipline of staying firmly on the sidelines until the market mechanics bend to meet your exact unforgiving rules.
It all comes back to patience. You don't jump to conclusions while the situation is still developing. You wait for the picture to resolve, you wait for the structural facts to present themselves clearly, and only then do you execute. Stop reacting to the flashes of green and red, wait for the close. Let the market show you its true intent, and stop paying for the privilege of being someone else's liquidity.